much anticipated IPO of Hyundai Motor India is here. This IPO is significant because Hyundai's listing marks the first time a major auto player in India has gone public in over 2 decades. Now, Hyundai Motor India is also the biggest IPO the Indian market has ever seen. Now, let's talk about the IPO details. The IPO is valued at a whopping 27,870 crore rupees, with the price band set between rupees 1,865 and rupees 1,960 per share. But here's the key point: this IPO is an offer for sale. Hyundai Motors' Korean parent company is selling shares, so none of the funds raised will go to Hyundai India itself. Instead, the entire proceeds will go to the parent company. Now, post-IPO, the parent company will reduce its stake from 100% to 82.5%. Now, let's shift gears and talk about what Hyundai Motor India does. Now, they're primarily in the business of manufacturing and selling passenger cars, and they're India's second largest automotive original equipment manufacturer. Now, Hyundai has about 13 models spread across various segments like sedans, hatchbacks and SUVs. Now, some of their most popular models include the Grand i10 Nios, i20, Venue, Creta, and their all-electric flagship, the Ioniq 5. Now, Hyundai Motor India does not just cater to the domestic market, it also serves as a crucial export hub for regions like Africa, the Middle East and neighboring countries. Now, another important piece of the puzzle is Hyundai's relationship with its South Korean parent, Hyundai Motors. Now, Hyundai Motor India plays a critical role in the parent company's global operations, contributing about 80% to their sales. Now, Hyundai India also pays the parent company a royalty of 3.5% on its annual sales. Now, let's look at the market opportunity. Over the past 5 years, from fiscal year 29 to fiscal year 24, India's domestic passenger vehicle sales have grown at a steady pace of 5% CAGR, despite a slowdown between fiscal year 19 and fiscal year 21, largely due to the pandemic. But looking forward, the industry is projected to grow at a CAGR of 4.5% to 6.5% between fiscal year 24 and 29. And if you look at this chart, you'll notice something interesting. Future growth in the PV industry is expected to be driven by the SUV and MPV segments, while the smaller segments like hatchbacks, sedans and vans may see more muted growth going ahead. Now, let's talk numbers again. Hyundai Motor India has shown strong financial growth over the last few years. Between fiscal year 22 and fiscal year 24, the company's revenue grew at an impressive 21.4% annually. But what's even more striking is the growth in their net profit, which surged about 44.5%, hitting rupees 6,000 crore. Now, naturally, this also helped to boost the company's PAT margin as well. Now, other profitability ratios too tell a similar story. Key metrics like return on equity and return on capital employed have also risen during the same time frame. Now, let's shift focus to the competition. Now, Maruti Suzuki leads the pack in terms of domestic sales volume, following closely behind is Hyundai Motor India, with Tata Motors and Mahindra rounding out the top 4. Now, together, these 4 players account for roughly 80% of the entire market. However, competition has been eating up over the past 5 years, with all players vying for a larger slice of the pie. Now, coming to the valuation, at the upper end of the price band of 1960 and fiscal year 24 earnings of 75 rupees, Hyundai is seeking a PE of 26 times. Now, let's talk about the company's strengths. Now, being backed by the Hyundai Motor Group gives the company some serious advantages. Now, Hyundai India benefits from the group's massive R&D investments and strong global brand recognition. Now, this backing also helps the company stay ahead of the curve, identifying emerging trends and understanding customer needs through their global network. Now, Hyundai India's production capacity is also set to increase from 8.2 lakh units to 10.7 lakh units once their plant in Maharashtra becomes operational. Now, Hyundai has also several models lined up to release in the coming quarters across both ICE vehicles and electric vehicles. Now, here's something interesting about the revenue strategy too. Now, Hyundai focuses on higher value vehicles. In fiscal year 24, 49% of its revenue came from cars priced over rupees 10 lakhs and about 20% from vehicles priced above rupees 15 lakh. Now, let's address some of Hyundai's weaknesses. As we talked about it earlier, the competition in the Indian auto market has really intensified. This has started to chip away Hyundai's market share. Between fiscal year 19 and quarter 1 of fiscal year 25, Hyundai's share of the passenger vehicle market has slipped from 16.3% to 14.6%. Now, meanwhile, Tata Motors has been on the rise, with their share growing from 6.3% to 13.5% of the same period. So the battle for the market dominance is heating up. There's also the shift towards electric vehicles. Hyundai still heavily relies on non-electric passenger vehicles, and while they've started to make moves in the EV space, there's no guarantee they'll succeed in rolling out an affordable and effective EV strategy that clicks with the market. Lastly, there's the issue of royalty fees. Hyundai India has to pay royalties to its parent company in South Korea. Right now, the rate is set at 3.5%, but if the parent company raises the fee, this could impact the company's profitability. Now, another challenge Hyundai faces is around production capacity. Right now, the company's facilities are running near their capacity limits, which makes the upcoming Maharashtra plant absolutely critical for meeting future demand. Now, this was our analysis on Hyundai. Do know that this video is just for educational purposes and it does not constitute investment advice. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.